It's tax time, so in this video, I'm going to share the 5 best ways to maximize your tax return so you can pay less tax. I'll include some quick wins that you can use this year, but I'll also explain some more advanced strategies that over the long term could save you hundreds of thousands of dollars in tax. So let's get started. So the first way to save tax is to claim all the work-related expenses that you're entitled to. And if you want to claim one of these work-related expenses, there's 3 general rules. The first is that you must have actually spent the money and that you weren't reimbursed for it by your employer. The second is that the expense must directly relate to your income. And the third is that you must be able to prove it, which includes a receipt or bank statement. And since the expense must directly relate to your income, the kind of thing you deduct will depend on your job. The ATO has a handy article titled Occupation and Industry Specific Guides, where it gives guidance on what you can and what you can't deduct in a range of different industries. For example, in the guide titled Doctor, Specialist, or Other Medical Professional, it states the following. Car expenses can't be claimed for normal trips between home and work, but they can be claimed directly between separate jobs on the same day or to and from alternative workplaces for the same employer on the same day. This is pretty typical of most professions, but it also includes do's and don'ts about travel, clothing, laundry, self-education expenses, and so on. But the most important of these is probably work from home expenses. So let's get into that now. To be eligible for this, you have to have actually done some work from home. It can't just be minimal stuff like answering an email or taking a phone call. And there's 2 methods that you can choose from: the fixed rate method or the actual cost method. So for the fixed rate method, this allows you to claim 70 cents for every hour that you've worked from home. So say you worked 1,000 hours, that's 1,000 times 0.7, which is $700. And this rate includes all the additional expenses that you incur for internet, mobile phone, electricity and gas, and stationery. And if you use this method, you can't go and claim an additional separate deduction for these expenses, so no double dipping. But you can make additional claims for technology and office furniture, such as chairs, desks, computers, and bookshelves. Just remember that if they're over $300, then they'll need to be depreciated over a number of years. And if you want more information on the fixed rate method, I've left the ATO article in the description. But now let's talk about the second method, which is the actual cost method. And this method allows you to deduct the actual cost of the expenses that you incurred for your internet, mobile, electricity and gas, and stationery. And the way you calculate the actual cost will depend on the item. So say it's an electrical appliance, you'll have to calculate the cost per kilowatt and the average kilowatts used per hour, and then multiply that by the total hours used. So here's an example of how that works, and I've also linked this article in the description. Obviously, these calculations are very tedious, so most people prefer the fixed cost method, but if you have a lot of expenses, it can be worth calculating both methods and seeing which one gives you the greater deduction. And whatever method you choose, you should claim all the deductions that you're entitled to, but just be careful not to overclaim because the ATO have announced that working from home deductions are on their hit list for 2025. So now let's talk about the next way to save tax, which is with private health insurance. In Australia, there's 2 Medicare taxes or levies. There's the Medicare levy, which everyone pays, and the Medicare levy surcharge, which is an additional tax or levy that is paid by high income earners who don't have private health insurance. So the Medicare levy surcharge starts at 1% for singles earning $97,000 a year or families earning $194,000 a year. And it rises to 1.5% for singles earning $150,000 a year or families earning $302,000 a year. And here's a table with the full thresholds and rates for the Medicare levy surcharge this year. Now, once you reach a certain income, the fee for private health insurance is actually cheaper than paying the Medicare levy surcharge. And that break-even point will depend on your situation, but the way you can calculate it is to calculate the Medicare levy surcharge that you would owe based on that table, and then go get a quote from iSelect or Compare the Market for the private health insurance and just see what works out cheaper. So just looking here, if you're a single earning 97 grand, that would mean that you'd pay $970. And the minimum private health insurance is a bit over $1,000. So once you're a bit over 100 grand, it's probably going to be pretty close, but it depends on your age and a bunch of your other details. So go and get that quote and do the calculation and see what works out cheaper. It should only take about 5 minutes. And now let's move on to the next way to save tax, which is with superannuation. Now, I know this is pretty boring, but it's very effective. So let's give a quick recap on how super works. So the way it works is your employer makes mandatory contributions into your super fund, and then your super fund goes and invests in shares, bonds, infrastructure, and a range of different asset classes. And this will depend on the investment option that you've chosen. If you haven't chosen an investment option, then you're probably put in balanced by default, which usually includes, say, 60% growth assets and 40% defensive assets. And that may or may not be right for you. So if you're not sure, just log into your super and check for the investments or my super or portfolio tab, something like that, and check what it is you're actually invested in. Now, super is one of the most tax effective ways to invest in Australia, because not only does it reduce your taxable income in the year that you make the contribution, but then again, every year thereafter. And once you transition it into the pension phase, it becomes completely tax-free. But there's obvious downsides, like you can't touch it until you're 60, and there's lots of important rules and caps that you need to be aware of. So if you want a full video on that, let me know in the comments and I'll make a full video. But suffice to say, it's a very tax effective way to invest in Australia. So if you want to make additional concessional contributions, there's two ways you can do so. Firstly, you can salary sacrifice, which is just where you ask your employer to increase the amount that they're putting into your super fund. Or you can make a personal deductible contribution, which is where you deposit money from your bank account into your super fund, usually at the end of the financial year, but you can do it whenever. And then you submit a notice of intent to claim form, which you can find in your super fund. Now, both ways have the same net effect, but salary sacrificing is a little easier to administer, whereas personal deductible contributions allow you to be more precise. So that might be helpful if you want to max out your concessional contributions. And the current concessional contribution cap, meaning the whole amount of your employer, salary sacrificing and personal deductible contributions, that whole cap is currently $30,000, but you can use previous unused cap for up to 5 years. So if you've got a big income or you want to get a lot into your super concessionally, then you can use those unused caps. So that's superannuation, but now let's move on to the last way to save tax, and in my opinion, the most effective, which is debt recycling. Now, debt recycling only applies to people that meet the following two conditions. The first is that you have a mortgage on your home, and the second is that you want to invest into shares or property or some income producing asset. And it's a strategy that involves converting the non-deductible debt on your home into tax deductible debt. And I'll explain how it works with an example. So let's say you have $1 million mortgage on your home and you have 100 grand in your offset that you want to invest into shares. Now there's two ways that you can invest that. You can just take it out of your offset and purchase the shares, or you can debt recycle, which involves taking the 100 grand out of your offset, splitting your loan, paying down the split loan, redrawing it, and then investing into shares. Now, in both scenarios, you have $1 million loan and 100 grand worth of shares. But the only difference is that in the first scenario, you have $1 million of non-deductible debt, whereas in the second scenario with debt recycling, you have $900,000 of non-deductible debt and $100,000 of deductible debt. That means you'll save tax each and every year for the remainder of your loan, which could be hundreds of thousands of dollars. But just a word of warning, if you do want to debt recycle, make sure you speak to a professional who has experience doing it several times with several different clients, because there's lots of small things that can cause the bank to close your loan or the ATO to deny the deduction, or in some cases even issue penalties. So if you want to debt recycle, please speak to an experienced professional. And that leads on to my last point, my last bonus tip, which is the importance of getting holistic advice. For example, from a tax perspective, you want a lower taxable income because it means you pay less tax. But from a mortgage or credit perspective, you might want a higher taxable income, especially if you're going to refinance or buy a house soon, because a higher taxable income generally means you get increased borrowing capacity. And this is why you need holistic advice. So make sure you tell your professionals about your entire situation and what your long-term goals are. Get them talking to each other and keep watching educational videos like this so you know what to tell them and what facts might be relevant. Now, this video is obviously not personal advice. It's just educational, informational content. But if you're still here, you obviously like it, so please subscribe, because I'm going to be making more like it over the coming weeks and months. And also check out this recent video I made on the income and net worth of the richest Australians. But otherwise, thanks so much for watching. Go and get those deductions, and I'll see you in the next video.